Welcome back students and scholars. In the previous video, we built the big picture of ASC 210 using three words: snapshot, time and netting. Now we are ready for the complete explanation. This video will cover the full ASC 210 balance sheet topic in a practical way without stretching a short standard unnecessarily. We will look at ASC 210-10, which deals with overall balance sheet presentation and classification, and ASC 210-20, which deals with offsetting. Think of this lesson as a guided walk through the balance sheet. First, we understand the structure, then we classify assets and liabilities, and finally, we decide whether amounts should be shown gross or net. Today's learning path has 5 focus stops: form, assets, liabilities, presentation, and offsetting. First, we will understand the balance sheet structure and the common layouts used in practice. Then, we will move into current and non-current assets, followed by current and non-current liabilities. After that, we will discuss presentation detail, what goes on the face of the balance sheet and what can be explained in the notes. Finally, we will study offsetting under ASC 210-20. This topic is compact, but do not underestimate it. In exams and real financial reporting, the mistakes usually happen in two places: classification and netting. So let us study both with discipline. The balance sheet or statement of financial position is a snapshot statement. It reports the entity's financial condition at a single point in time, not across a period. That is why the reporting date is so important. At that date, the entity shows its assets, liabilities, and equity. Assets are resources controlled by the entity that are expected to provide future economic benefits. Liabilities are present obligations that require future sacrifice of economic resources. Equity is the residual interest after deducting liabilities from assets. And of course, the fundamental equation remains: assets equal liabilities plus equity. This equation must hold at every reporting date. But remember, a correct equation alone does not guarantee clear presentation. ASC 210 does not force one single physical layout for the balance sheet. Different formats can be used as long as the statement communicates financial position clearly and consistently. The balanced format shows the classic equation: assets equals liabilities plus equity. The equity format rearranges the same idea as assets minus liabilities equal equity, which is common in some reporting contexts. The account form presents assets on one side and liabilities plus equity on the other side, almost like a traditional ledger view. The report form presents assets first, then liabilities, then equity in a vertical flow. The practical lesson is simple. The form can vary, but the logic must remain clear and consistent. The heading of a balance sheet is not a decoration. It is part of financial communication. It tells the reader whose financial position is being shown, what statement is being presented, and the exact reporting date. The entity name should identify the legal reporting entity. The statement title may be balance sheet or statement of financial position. The reporting date tells us the snapshot moment, such as December 31st, 2024. Consistency also matters. If comparative balance sheets are shown, the classification scheme and line item groupings should be comparable across periods. If prior period amounts are reclassified to match the current presentation, that should be handled with proper transparency. Now we enter ASC 210-10, the classification engine of the balance sheet. This part helps us separate assets, liabilities, and equity into meaningful groups, especially current and non-current categories. Why does this matter? Because users do not look only at total assets or total liabilities. They also look at working capital, current ratio, quick ratio, liquidity strength, and near-term repayment pressure. A misclassification can make an entity look healthier or weaker than it really is. So ASC 210-10 is not just about tidy formatting. It helps users understand the timing and quality of resources and obligations. In simple words, classification turns a list of balances into useful financial information. Let us start with current assets. Under ASC 210-10, an asset is current when it is reasonably expected to be realized in cash, sold, or consumed within the longer of 1 year or the entity's operating cycle. This longer of idea is extremely important. Many students remember only the 1 year rule, but that is not enough. The operating cycle is the time needed to convert cash into inventory, inventory into sales, and sales into cash collection. For many businesses, the cycle is less than 1 year, so 1 year controls. But if a manufacturer has a 15-month production and collection cycle, related inventory and receivables may still be current because the operating cycle is longer. Cash looks simple, but ASC 210 can make it a real classification trap. The key question is not, is it called cash? The key question is it available for current use? Unrestricted cash that can be used for payroll, suppliers, and operating needs is normally current. But restricted cash may be non-current if it is set aside for a long-term purpose, such as a bond sinking fund, plant expansion, or long-term debt collateral. Take the example on this slide. Regiment Tool Sink has cash in an escrow account restricted for factory expansion in 18 months. Even though the account contains cash, it is not available for current obligations. Therefore, current classification would overstate liquidity. Beyond cash, several asset categories commonly qualify as current. Trade receivables are current when they are expected to be collected within the operating cycle. Inventory is current when it is expected to be sold in the normal course of business. Prepaid expenses are interesting because they may not turn into cash directly, but they are current because they prevent a near-term cash outflow. For example, prepaid insurance means the company will not need to pay that insurance cost again during the covered period. Marketable securities may also be current when they are held for near-term liquidity and are readily convertible to cash. The principle is always the same. Understand timing, purpose, and expected use. Non-current assets are resources that do not meet the current classification criteria. These assets normally provide benefits beyond the current operating cycle or 1 year. Long-term investments are not intended for near-term conversion into cash. Property, plant, and equipment support operations over several periods. Intangible assets such as patents, trademarks, customer relationships, and goodwill provide future benefits but are not current operating cycle resources. Restricted funds are also non-current when they are tied to non-current purposes. A good exam reminder is this: do not classify by account label alone. A receivable due in 30 days may be current, but a long-term installment receivable or officer loan may be non-current. Now let us turn to current liabilities. A liability is current when its settlement is expected to require the use of current assets or the creation of other current liabilities within 1 year or the operating cycle, whichever is longer. Notice how this mirrors the asset side logic. For liabilities, the focus is settlement. Will the obligation be paid soon using cash or other current assets? Will it require a new short-term obligation? Is it due on demand or callable by the lender? If the lender can demand repayment at any time, the liability is generally current, even if management does not expect the lender to call it. For covenant violations and refinancing, ASC 470 may also become relevant. Common current liabilities include payables, accruals, deposits and advances, and the current portion of long-term debt. Accounts payable arise from purchases from suppliers. Accrued expenses include wages, interest, taxes, and other obligations incurred but not yet paid or invoiced. Customer deposits, unearned revenue, gift card liabilities, and agency collections are current when performance or remittance is expected within the operating cycle. The current portion of long-term debt is the part due within 12 months or the operating cycle, and it is reclassified from non-current as maturity approaches. The practical test is not what is the account called, The better question is, when and how will this obligation be settled? Non-current liabilities are obligations not expected to be settled within the current operating cycle or the next 12 months. These are the long-term financing and structural obligations of the entity. Examples include long-term notes, bonds, term loans, and subordinated debt. Lease obligations under ASC 842 may have both current and non-current portions. Contingent liabilities such as litigation, environmental obligations, warranties, and guarantees may be accrued or disclosed depending on the facts and relevant guidance. Redeemable instruments and benefit obligations can also create non-current liabilities. Here again, classification is about timing and expected settlement. A liability can be very real but still non-current if settlement is beyond the current gate. AST 210 also allows judgment in presentation detail. It does not prescribe a fixed number of line items for every balance sheet. External public statements often present summarized lines such as prepaid and other current assets or other accrued liabilities with detailed breakdowns in the notes. Internal management statements may show far more detail because managers need operational visibility. The guiding principle is usefulness. A balance sheet should not become so detailed that it hides the main picture, and it should not become so aggregated that material information disappears. Immaterial items can be combined, but material items should be presented separately or disclosed clearly enough for users to make informed decisions. Now we reach ASC 210-20, offsetting. The default rule is gross presentation. That means assets should be shown as assets and liabilities should be shown as liabilities, unless the right of set-off criteria are satisfied. The four locks are determinable amounts, a right to set off, intent to set off, and legal enforceability. All four must work together. A master netting arrangement alone is not enough. Look at the Not Ledger Bank example. It has a receivable and a payable with the same counterparty, but legal enforceability is uncertain. In that situation, netting cannot be assumed. If one lock fails, gross presentation usually wins. That is the safest memory rule. Let us close the complete explanation with our memory map. Snapshot, time, netting. Snapshot means the balance sheet captures financial position at one date. Time means assets and liabilities must be classified as current or non-current based on timing, purpose, restrictions, and expected settlement. Netting means gross presentation is the default, and net presentation requires the proper right of set-off support. ASC 210-10 is the classification engine. ASC 210-20 is the offsetting gate. In the next video, we will test this full topic through 12 MCQs and 4 short answer questions. If this lesson helped you, please like it, share it, subscribe to Commerce Regiment and support the channel. Now, let us move from explanation to practice.